All right, let's start. The people are asking about exam one. So you have two questions. One is all the stuff we've been doing. What is a portfolio, the why, what, how, all the asset classes. It is open book, but if you copy and paste from the notes, you'll get almost no credit. All right, I'm not going to read by words in the exam. I already know what I think. You guys show me what you think. So the recommendation is a massive question. So the recommendation I have, read the class notes, listen to the lecture, read the class notes, put everything aside and write that section entirely off the top of your head. So it's all in your words. And then go to the next section. So how much of this is important that you should memorize? You shouldn't memorize any of it. You should just know this stuff. This is stuff you know as a finance major. So don't bother memorizing it. Just put it in your permanent memory. The best way to do that is to sit down with someone in the class and tell them your answer off the top of your head without looking at your notes. You should be able to do this, and as long as it is involved as it is, you should be able to do the entire thing off the top of your head without notes. I gave you some mnemonics, the DC cuts I, the bucks, and those kind of things that help. I'm a big boy. Retention is so important to me. I think college retention is practically 0%. I think students go to college and learn nothing and get a degree, and their attitude, I'll learn it all on the job. And it's like, well, is that the case? We could save a lot of money. There's some pretty expensive buildings sitting here. There should be retention. So learn this stuff. It's really important stuff, and it'll help you great in an interview. So today what we do, keep working through the DC cuts I, finish up credit, maybe even get into the stocks today. We'll see. So last time we were talking about credit. So credit, you have high quality, low quality, and in a recession, low quality spreads really gap out a lot, so they underperform. In a recovery, spreads narrow. So you want low quality when spreads are narrowing. You want high quality when spreads are gapping out. So you have to have a few things in mind here. So this where it gets a little tricky. On question 2 on the exam, where you're doing class, there I'm giving you a scenario, and you've got to respond with an S allocation. We're going to do a lot of practicing on that. But if your boss says, hey, I expect a recession, he or she's probably saying two things. It's going to be bad for low quality, and probably interest rates are going to fall. If your boss doesn't tell you about interest rates, you'll just assume, hey, recession, because interest rates normally fall in a recession. Not all the time, but normally. It's pretty rare. So if they don't tell you, if they expect a recession with rising rates, they'll have to tell you that, because that's pretty abnormal, right? So that becomes the case. So here, they tell you, I think we're going into recession next year. That implies the risk-free rate's going to fall. So when I say interest rate's going to fall, we're talking about the risk-free rate. Remember, spread is what you put on top of the risk-free rate. So the risk-free rate's going to fall, but what are spreads going to do? They're going to go up. So what does the interest rate on the bond do? You don't know. If the risk-free rate falls 100 basis points, with spreads gap out 150, your bond's going to lose value. If the risk-free falls 50 and spreads gap out 25, your bond will be up, but you would have been better off with the treasury. So that's kind of what you're looking at. It's that combination. But anytime you see a recession, it's pretty easy. You increase quality. You buy high quality instead of low quality. You invest bonds instead of stocks. You do large cap instead of small cap. We're going to look at it. The quality is the most thing. If someone's expecting a recession, that implies some pretty obvious asset allocations. I mean, you probably already knew that in the class, right? If hey, I expect a recession next year, so I recommend you increase your stock allocation. Does that sound normal? You're really expecting a really bad recession next year, you better load up on stocks. Does that sound normal to anybody? It sounds pretty bizarre, doesn't it? So it's pretty obvious. So same thing, I expect a recession next year. You should be buying a lot of junk bonds. That is a bizarre thing to say. What do you want to do with junk bonds if you expect a recession? Avoid them like the plague. They're horrible. All right. So normally in a recession, we imply the risk rate's going to fall. Spreads will almost always 100% of the time widen, gap out. So you want to increase quality. So the key here is not what have spreads done, but what you expect them to do. So if you're expecting a recession, you expect them to gap out. So here, before the recession, to triple B had a 225 spread over treasuries. Treasuries were 5%. So the bond had a 7.25 discount rate. 5% for the risk-free plus 2.25% spread. All right, so you bought a bond with a yield of 7.25. Then the recession hits. What does the treasury rate do? It falls dramatically, 250 basis points from 5% to 2.5%. So if you own that treasury, you'd be really happy. That price would be up a bunch, but you don't. You own the triple B. And so the spread widens to 600 basis points. So what's the current yield? Risk-free rate plus the spread, 8.5. What did your bond price do? Your yield went from 7.25 to 8.50. Interest rates rise. What do bond prices do? They fall. So you would have lost money on this bond. Your treasury would have made a lot of money. The triple B bond would have lost money. That's what happened in 2008. Treasuries are up 20, 30%. Corporate bonds are down 15, 20%. Now, if we had a triple B bond, the spread might have gone from 10 to 15. The triple A bond probably would have been up quite a bit in price, like not as much as the treasury, but would have been up pretty heavy in price. If your boss says, I expect the economy to take off with high economic growth, what does that imply for the risk-free rate? Probably going to rise. Risk-free rates normally rise in a strong economy. There's an exception. We'll talk about the exception in 1980s, but so it implies the risk-free rate's going to rise. Why? Because there's more inflationary pressure. There's probably the Fed's probably going to start tightening at some point, but spread's going to narrow because you have so much good news. Firms are less likely to go bankrupt. And so that's when you can move to lower quality bonds. Oops. This thing's really sensitive. You can move to lower quality bonds. So if you're expecting a strong economy, you're probably going to reduce your bonds and increase your stocks. Within bonds, you're going to buy lower quality bonds. Within stocks, you're going to buy lower quality bonds like small caps. So that's, you see how this whole thing is together. You can see on question 2, that recession or growth is 70% of your answer. That tells you a lot, just what you expect in a recession. So it tells you about low risk, low quality versus high quality, also tells you what to expect interest rates to do. So weak economy, you're probably going to increase quality and you're probably going to lengthen duration. Why? Because interest rates are falling. Strong economy, you're going to move down in quality and you're probably going to shorten duration. Probably not 100% of the time, but 90% of the time. That's a pretty good answer. In an interview, you're pretty safe to have that as your fallback. So when doesn't it make sense? I'll get into that. Now, C also, it's not just credit, it's also sector. So don't forget to put sector into your answer. So credit is, do I want high quality or low quality? But credit is also which sectors do I want to be in? So it kind of depends on what recession are you expecting. Some recessions, hit certain industries. So we saw in 2020, we're all worried about the travel companies, Carnival Cruise Lines and those type. We also got worried about some of the energy companies because gas prices and oil prices fell so much. So there's certain sectors that did pretty poorly. Well, we'll get into credit a little bit more when we talk pricing bonds. There's some really good studies out there by Moody's and S&P where they show you historically how different sectors do in different environments. Consumer stocks sometimes can be an issue. Obviously, right now, real estate stocks are a little bit worried because people aren't going back to work. And those, looking in New York City, there's a lot of empty buildings right now. I don't know about San Antonio, but just in Austin, have y'all driven by Austin? My word, you should. When I lived in Austin, that dinky little Holiday Inn on I-35, that used to be like the tallest building in town. Now you don't even notice it. It's so puny. There's a lot of office space in downtown Austin. Do you think it's all leased out? I mean, there's a lot of billionaires and those kind of people in Austin, a lot of hedge funds, but that's a lot of office space. A lot of those people probably work from home. So it'd be interesting to know what's going on in downtown Austin. with the real estate, is that industry at risk of having a lot of defaults? You're certainly seeing that in China, right? China's real estate market is just tanking right now. So there's certain sectors you're more worried about than others, and we call that event risk. There's certain times, certain industries are just under a lot of pressure, and they tend to blow up at certain times all together, all at once. You certainly saw that real estate in 2008 in the United States. You're seeing it real estate in China right now. So you have to consider that that even if you're expecting a strong economy or weak economy, that certain sectors might be hit more than others. So event risk is when management does something to you that just makes the company much weaker, and you're kind of stuck with it. So they might go, have you ever heard of an LBO? That term still used, the leverage buyout, when management just essentially puts a lot of debt onto the firm and they take it over, and now they're settled with all this debt. What does management do? They drain as much cash out as they can, and then they leave, and the firm just goes under. So some sectors have more event risk than others. It was interesting at UTSA, their philosophy was to avoid event risk. So they loved banks because banks are heavily regulated. So they tend to be protected from event risk. That worked really well until 2008, when you're over allocated on financials. In 2008, when financials are crashing, UTSA had one of the worst years ever on the fixed income side. They were just overexposed. They were trying to avoid event risk and ended up being too exposed to one particular industry. So don't forget to talk about sector. All right, so here's the combinations. So this is a really good chart to understand. This would be a good one to put into your own words onto your answer. So the risk-free rate, what treasuries are paying, that can rise or that can fall. And then spreads, what you get for buying corporates, high quality or low quality, that can widen or that can narrow. So let's talk about when interest rates rise and spreads narrow. That's a strong economy, typical strong economy. Economy is doing well, interest rates are rising, you're seeing spreads narrowing. This is a time for junk bonds. Junk bonds do great. Junk bonds don't really care about interest rates, the risk-free rate. They just want to survive. You just want them to make the next payment. So you don't really care about duration with high yield. So there you have a strong economy. You want to bet on lower quality, and you want to avoid duration, because a lot of duration and high quality long duration is going to do badly because interest rates are rising. What about when interest rates fall and spreads widen? Well, that's a recession. That's when you want a lot of treasuries, right? Your risk-free rate's falling because of a recession. Spreads are widening because of a recession. You want to buy treasuries. And what kind of treasuries? Short-term or long-term? Long-term. Why? Because interest rates are falling. So interest rates are falling, you want to lengthen your duration. Right? This chart really tells you a lot. What about the two charts I don't have? Rates are rising and spreads are widening. That's what we saw. That's what you see when inflation takes off in the 1970s. So why are interest rates rising? Not because we have a strong economy, but because of a lot of inflation. Bond people don't like inflation, so they demand higher yields. But inflation happened in the 70s. Y'all remember the 70s? I was in middle school in the 70s. Gas prices were up. OPEC was limiting oil production. We had a really horrible Fed that was just printing money left and right. Heavy inflation. Y'all know how high inflation got in the 70s? Yeah, up to 15%. That's pretty high inflation. I mean, it's not Argentina, but it's a pretty high inflation number. So you certainly notice that, especially if your wages are going up 5-6%. So the mentality coming out of the 70s for us was inflation is high. I remember at UTSA, I was forecasting salaries, and someone said, "Can we use a 5% inflation number for next year?" I thought 5%, well, that's a really low number. Today, that sounds like a really high number to say for a long-term inflationary number, but back then we were so used to double-digit inflation. So that's pretty unusual. Will that come back? Well, that's the big issue right now. Can the Fed fix this? We got a better Fed now than we had in the 70s. So we'll see. Jerome Powell is like, he's he refuses to get off that 2%. He's like, I'm going to get inflation back to 2. Not many people believe him, but I don't think that he's so wed to 2%. I think he's scared to say anything differently. That he wants everybody to focus on getting inflation down. It has come down pretty well, but it's still much higher than he wants. So we'll see. The 70s was an entire decade of that problem. He's trying to keep this to a couple of years and fix it. What about down here? Interest rates are falling, but spreads are narrowing. Well, that was the 1980s after the 70s. Volcker comes in, causes 2 recessions, greatly weakens the economy, interest rates start falling, inflation falls, and then everything gets solved, and suddenly we have this great recovery, but interest rates were so high, they're still falling, but the economy is doing well. The 80s and 90s were, it's like you could not make an investment mistake. If you're losing money in the 80s and 90s, you were investing in Vegas or something, because you were not, you almost couldn't make it'd be hard not to make money in those years, especially the 80s after. I mean, I realized 87, we had the big stock market crash, but even 87, y'all realize in 87, when the market fell 23% in one day, the market was up in 87 for the whole year. It was actually a positive year. So even 87 with that big crash, we still had a positive return year. Are we going to get one of these? I don't think we're to the 70s yet to have kind of that 2-decade-long recovery. Maybe we're getting a little bit of that relief early. We've seen stocks doing better this year. We'll talk about growth versus value and what's going on this year. But in interviews, you got to focus on the 2 blue ones, because that's the norm. But do you realize inflation is the wild card? Inflation messes everything up. It's a really, really tough one. Question on this page, this is a really important page. Could you explain this page to somebody off the top of your head? You get to that comfort level. You just say, hey, here's the norm. Expect a recession. Rates are going to fall. Spreads are going to widen. I'll be moving up in quality, linking out my duration. Does that sentence I just said make any sense to you? Is that feeling more comfortable? I expect a strong economy next year. I think we're going to come out of this. Real rates are going to probably rise. So I'd be shortening duration, but man, go low quality. This is going to be a great time to be taking risk. That's the kind of way you want to be thinking through this. And then these 2 other boxes, if you have an opinion like that, you just got to be ready to defend it, because that's the unusual stance that if you think, well, and I've heard that, right? You've seen the commercials, people selling gold right now. That's their thing. We printed too much money. We're out of control. You need to be having money in gold. They've been saying that for years. They've been wrong for over and over and over and over again, but eventually they'll be right? That's the key. You stick to your argument, and you're wrong for 30 years, and you're 31, you're right. And you say, see, I told you. And people are like, okay, you finally were right. We'll see. So I've given you some of these examples. So the risk-free rate drops 50 basis points. The spread widens 75 basis points. So the yield goes down 50, goes up 20. So you go up 25 basis points. So your price is going to fall a little bit, but not a whole lot. That's the way you're kind of thinking about this. But the Treasury is the place you want to be here, because the Treasury yield fell 50 basis points. The Treasury is going to be up a bunch. So if you expect spreads to widen, just buy Treasuries. They're going to give you a better return than corporates in all cases. But the corporate price itself may or may not fall, depending on what spreads do versus a risk-free rate. I'll give you a couple other examples in the textbook. You can read through those and get comfortable with them. All right, so there's credit. Credit's pretty important. Someone was asking me about mortgage banking today. What's mortgage banking about? I hate it for the fees are ridiculous. Our industry charges way too many fees for nonsensical things. I'm getting charged fees, and the banks are like, "Oh, we just need it for our paperwork." It's like, you don't really need it. Yeah, but we need it, and they're going to charge me $3,000 to go get something they don't really need, but they have to check a box. It's ridiculous, the fees. But what is mortgage banking? It's credit analysis. What's the difference between mortgage banking and other lending? Well, mortgage banking, you got this big piece of collateral sitting there that if the person doesn't pay you, you got some collateral there, but it's all about assessing risk. Is the borrower going to repay you? That's what credit's all about. If they're not, you don't expect them to repay you, you're going to charge a much higher interest rate, much wider spread. There's not a lot of difference. And even stock analysts, it's similar type of analysis. Your analysis is the same type of ratios, but maybe a slightly different kind of a focus. All right, let's talk. So we're DC cuts I, DR. Remember DC cuts I? D, duration, measure of weighted average time of maturity, 3 categories. Okay, and your strategy is related to what? Whether rates are rising or falling. Okay, rates are rising, short in duration, rates are rising, small length in duration. All right, DC, convexity, I only gave you 2 categories there. Positive and negative convexity. All right. So there, what are we worried about? Not rates rising or falling, but what? Volatility. How volatile do you expect rates to be? You expect rates to get more volatile? Well, you want positive convexity. You expect rates to become less volatile? You want the sell convexity because you get that higher yield. And you expect to keep it because rates are going to be stable. Then we just talked about the second C on credit. So you got UTSA. Do y'all remember those? Taxes. What was the S? Structure. Inflation. Yeah, some people on the S, they say like styles, and no, style is the S for stocks. We don't talk about style with bonds. All right, US versus non-US. Most people do not consider this to be a normal asset class. It's an alternatives because of currency. When you buy a non-US bond, the bond may be real nice and stable, but the currency is going to make it fluctuate pretty dramatically. So when you buy non-US bonds, just be ready. You're really buying currencies more than anything else. So when you invest in developed market bonds, so countries like UK, Germany, you buy a bond in the UK, you're kind of betting on the pound, the UK pound, which has been pretty volatile the last several years. The bond might do great if you lived in the UK, but it might do horribly if you live in the US. So it's just something to consider. You got to be aware that when you do that, you're really buying a currency. What is a currency all about? So the currency investors, I've hired a few non-US bond investors. We didn't do it a lot at USA, but we had a UK office and a German office. So we had exposure to the pound and the euro. So we bought bonds not because we liked non-US bonds, but because we had exposure to those currencies. But our bond investor in the UK, he didn't have a PhD in finance, he had a PhD in economics. Currency traders are usually economists. Why? Because you have to look at the country's inflation, you got to look at their the balance of payments, you got to look at well, just how much their money supply is. So it's really an inflation play and an interest rate play. So I don't know, in money and banking, y'all are talking about this, aren't you? So what happens to the US dollar if inflation drops in the United States? Does it strengthen or weaken? Strengthens. What happens to the US dollar if interest rates fall in the US? Weaken, right? So the US dollar likes low inflation and high interest rates. So that's good. Why? Because you have high interest rates and no inflation, people buy bonds here and they get a much better return. So you have to know about their inflation, you have to know about interest rates. And inflation interest rates can be influenced obviously with money supply and the balance of payments, whether it's trade or even just fiscal deficits, those type of things. So all that plays in to currencies. So when you buy so if you went over to UK and bought some UK bonds, you have to really study the pound and see what you think it's going to be. Now you could buy UK government bonds and hedge out the currency, but you just went through a massive amount of work to do something you could have done just by buying US treasuries. Because they're essentially the same thing. High quality government bonds. So he was like creating US treasuries, you did 6 trades instead of 1. It's just a lot of work. So really, if you're going to buy non-US bonds, you're really going after the currency, huh? Well, Brexit, the pound certainly nosedive, and I can't get used to the pound being as low as it is. My whole life, the pound was 170, and it's like you can't use that anymore. So I've never been to the UK, but this would probably be a good time to go. Be a little cheaper. Yeah, the Brexit certainly has been an issue. it came back somewhat, and it's something, it's been all over the place. The Russian ruble is a good example. It crashed after the attack, then it came back, and now it's nosediving again. Currencies are pretty unpredictable. There's so many years, it's kind of hilarious. Go back and look at the articles early in the year. Well, people know for sure the dollar is going to weaken, and then it strengthens, or they know for sure the yen's going to strengthen and it weakens. We're really horrible at predicting currencies. It's really tough to do. And so if you do this type of investing, you're gonna have a portfolio that's really, really quite volatile for something that's a nice high quality bond. So you can go lower quality. So if you want to make it more about spread and not currency, you can buy emerging market debt. That for sure is an alternative for most people. That's a pretty rare asset class. Emerging market stocks have become pretty popular, but emerging market debt is still a buyer beware kind of risky market. We'll talk more about emerging countries, but have y'all heard of the Big Mac Index? Nope, I put it in the wrong spot. Let me see, I have it in there. I, for some reason, put it under inflation. Let me show y'all here. So here's the Big Mac Index. The Economist came up with this. The magazine The Economist came up with this. Do y'all read The Economist? That's my one magazine. I read it. I've only missed one article in The Economist in the last 20 years. I've read the entire thing. There's one article they had on vultures and how they eat. And I got one sentence in and said, you know, I can probably skip this article. It's a really grotesque article. But other than that, I've read every article. It's a really good magazine. I highly recommend it. They go around the entire world. So if you want to know what's going on in countries you've never heard of, and that's one thing I do. If I hear a country I'm not sure where it is, I put it in my maps. I want to know what countries are around it, so I can understand kind of what's going on. So several years ago, they came up with the Big Mac Index. They actually meant it somewhat as a joke, kind of tongue in cheek. They wanted to find some product that was sold all the way throughout the entire world and was real similar everywhere it was sold. And then they wanted to compare what they call purchasing power parity. You're probably talking about that in money and banking, purchasing power parity. And so they did that one article, and people like the index so much they kept it. They keep updating it every year. So essentially what they're saying with purchasing power parity, if you live on the frontier of US versus Canada, you shouldn't be able to drive into Canada, buy $1 million of Big Macs in Canadian dollars, come back and sell them in the United States for US dollars and make a profit. They should be the same price in both countries. There shouldn't be a difference. And so what the Big Mac Index is saying is how overpriced or underpriced a currency is when you look just at the price of the Big Macs. Now, obviously, Big Mac's not exactly the same everywhere. Not every country eats beef, so there's a few differences, but it's a fairly similar product. And I can say that for sure. When I went to Greece, I liked Greek food for like 2 days. And then it's like, I can't eat the too oil. It's just a lot of oil. It's just too much for me. It's too similar. So our last meal was at McDonald's. And it tasted exactly like it did here. I was really happy to go to Athens and have a good, I didn't eat a Big Mac, but McDonald's, very similar throughout the world. And so the US has typically been really low on this list. Right now, the US dollar is pretty high on the list. The US dollar is stronger than it's been in quite some time. So it used to be kind of in the bottom third. Switzerland's like almost always at the top for some reason. So these currencies can say, so they're saying Switzerland looks 38% overvalued, but it's been overvalued for years and years and years. So you can't just short the Swiss franc and think you'll make money because it just stays up there pretty continuously. And you can see the other countries out there. So if you look at the actual index here, you just type Big Mac Index. And this is the August 2023 Big Mac Index. And you can see the cheapest currency out there is Taiwan. Taiwan, probably a wonderful place to visit. It looks like a really gorgeous country. If you go right now, it's probably gonna be pretty cheap. Hotels will probably be really cheap. Supposedly, there's one time the pound got so rich that people are actually flying from London to New York to have dinner. And that seems like it still wouldn't work out. They're probably pretty wealthy people, but I've had dinner in New York where it was like, $600 a person, so maybe you can make that work out. But the currencies can move pretty dramatically in all different directions. So right now they're saying the British pound is, where was British? They say British pound is 3.4% undervalued. So you could fly to UK, buy $1 million in pounds, £1 million worth, whatever, Big Macs, put them on the plane, come back, sell them in the United States, and you make a small profit. Assuming you can sell Big Macs in the United States on the street corner, and that might be a little tough. And they may not last the flight, but it's a conceptual idea. I have to think there's got to be some product besides the Big Mac that's more common in the world. Maybe the iPhone will take over here pretty soon. The iPhone price is pretty radically different though in each country, right? In poor countries, they got a much cheaper version. So yeah, possibly. Some countries like India, they're much more sophisticated buying jewelry. They think Americans don't know the value of gold, and so some countries that's a much bigger part. Some countries, that's how they actually save their money, is in jewelry. So they just know it better than the United States. But yeah, I don't know if there's any product. I do know smartphones are definitely. I was in Costa Rica and we work with this indigenous group, and they're kind of very traditional, no cars, no electricity. And this young lady was on a mule, beautiful garb she was wearing. I thought, I was going to take a picture, but I thought it might kind of insult her, another culture, or some stranger taking your picture. But it's so beautiful in the mountains. And guess what she's doing sitting on the mule? She was texting on her smartphone. So not as traditional as you would think. So smartphones, I have so many Facebook friends in Costa Rica that don't have electricity, but they have somehow a smartphone and texting. So smartphone might be becoming more common. But the Big Mac's what they picked, and Big Mac is a pretty good selection. Could you actually go out and short the franc and buy the Taiwanese currency and make money doing this? Probably not. Probably not going to be a good move. Now, the purchasing power parity, PPP, you can look it up in Bloomberg. They'll actually do purchasing power parity using a lot more products than just a Big Mac, and you can see what's overpriced and underpriced. There have been many, many, many articles written. Can you actually make money using PPP? And it's not a very successful way to invest. Currencies are just very, very, very tough things. So for most people, they're just going to buy bonds in their country, in their currency. I had a friend of mine, he's from India, and he noticed in India the bank CD rates were like 12%. So why don't I just go buy some bank CDs at 12% in India, where they're only 2% in the United States? I said, well, you're taking huge currency risk. And so what the market's telling you is the Indian currency, what is the Indian currency? Rupee. That currency is going to weaken quite a bit. And the market's right about the rupee, you'll end up with the exact same CD return when you convert that back to US dollars as you would have if you just bought a CD in the US. Now, if the market's wrong and it doesn't weaken that much, yeah, that would have been a good investment. But it could weaken even more. So what the bond market is telling, this is what we expect the currency is going to do. If you buy a CD in India, you should get the exact same return as buying a CD in the US if the market's right about what that currency is going to do. So essentially the market's saying we're expecting much higher inflation in India, the United States, so their currency is going to weaken. So when you buy it in India and convert it back to US dollars 5 years later, you end up with the exact same return. So even then, you're saying, wow, 12% versus 2%, even then you're making a bet on the currency. Y'all know what the carry trade is? That's something you can look up. So Google carry trade. So what is carry trade?
It's where you borrow another currency and then use it to buy, like, for example, like US bonds and something like that. And then basically capture spread.
Yeah, so if you look up carry trade, do carry trade in the country Japan.
Oh yeah, that's very.
Because there was a time where the carry trade was people are borrowing in Japan and investing in a place with higher interest rates. And that was a great strategy as long as the Japanese currency didn't move. And what happened in those markets is became such a huge trade that the stock market started selling off anytime the Japanese currency moved. So just that one trade was so massive, the Japanese yen started driving the US stock market. So, yeah, currencies are not my thing. I can promise you that. I went to Germany once when they had the Deutsche. I hope I haven't told you all this story, but it was really cold. So I bought a sweater. I thought it was $100 sweater. I get home, it was a $500 sweater because I divided and I was supposed to multiply. So I'm not good at currencies. I hate currencies. Some of y'all are probably really good at currencies if you lived overseas and you're just used to that conversion, but my brain doesn't do that.
Was it a good sweater?
Oh, it's great. I still have it and it's really warm. It's a beautiful sweater. The lady was really happy when she sold it to me. I was like, why is she smiling? And this was years enough ago that you could probably triple that today because of inflation. So it was probably a $1,500 sweater in today's dollars. All right. So T for taxes. So taxes are important because we have these special bonds in the United States that are tax-free. And because of that, you got to make an adjustment. You can't just look at their yields. You got to make an adjustment. So municipal bonds and other kind of special type, hospital districts or whatever, there's a lot of different bonds that are considered tax-free, state, city, county. They're tax-free at the federal government level, and they can be tax-free at the state level. Obviously, in Texas, they're not because you have to have a state income tax to be tax-free. USA did the strangest thing. They started a Texas municipal bond fund, thinking that Texas might get an income tax. And it's like, are you crazy? Texas might get an income tax. So they started to shut the fund down because nothing happened. Like, that was the weirdest thing. Why? Because that cost them hundreds of thousands of dollars. So I never understood that. But in Texas, doesn't work. Now, some states, like California, you buy municipal, it is tax-free from California taxes, but a lot of times they say it has to be California municipal. And so what Fidelity and USA or Victory Capital set up is a California fund or a Florida fund to make sure not only is it tax-free from federal government, but also getting tax-free from the state. Now that can be really risky. Why could that be really risky? You're loading up on bonds where? All in one state. So that, you gotta be careful. So you're trying to choose between taxable bonds and tax-free bonds. Depends on what your tax rate is. I had a debate with one of the other professors on how I did this, but let me show you how I did it. The tax equivalent yield is you take the tax exempt yield and you divide by 1 minus marginal tax rate. Since what we're going to do is take that tax-free yield and we're going to increase it so we can compare it to the taxable yield. She said, that's really stupid. What you should do is take the taxable yield and multiply it by 1 minus the tax rate, bring it down. Her way makes more sense, but why do I do it my way? Any guesses? Because I'm stubborn, not too bright. Which do you think is how it's done in practice? My way. All right, I do it the way it's done in practice. Which would you rather learn? The way it's done in practice. This is how it's done in practice. Why? Well, because this is a number calculated by the municipal bond investors. They'd much rather gross up their number than take the other one down. So different from your perspective. So essentially what you say is, let's do everything on a before tax basis. So let's bring the municipals up. And she says, well, you can't actually get that yield. That's true, but we're just doing it for making a decision on what we're going to buy. So when I did this, that intermediate, these are both intermediate. So the duration's the same. They're both the same credit quality. So the only difference here is the tax. No duration difference, no credit difference. So the taxable fund had a 3.27 yield. The tax exempt had a 2.82. Our marginal tax rate, I may give you the marginal and effective tax rate, but you always use a marginal tax rate. When you're making a marginal decision, use the marginal tax rate. So let's say your tax rate is 25%. So the tax equivalent yield is the 2.82% from the tax exempt bond divided by 1 minus our tax rate. That grosses up our yield to 3.76. We compare that to the 3.27, and we over-allocate the tax exempt bonds because they have a higher tax equivalent yield than the corporates. So we let that sink in. The mistake students make on the exam is I see students take the 282 divided by 1 minus 0.25 And then they take the 327 and divide it by 1.1 minus 0.25. Why would you take the 327 and divide it by 1 minus the tax rate? You wouldn't. There's no reason to do that. All right. You only take the tax exempt, you gross it up so you can compare those two numbers. Now, here's the numbers from right now. The taxable was 396. The tax exempt was 328. You take the tax exempt 328 divided by 1 minus 0.25 and you get 437. So what would you recommend here? Overweight municipals. Now, if you listen to my wealth management blog, I talk about, I'm not blog, my wealth management YouTube channel. We talk about this. There are a few choices in there. You got bank CDs. You also have life annuities. Life annuities are interesting. They're not tax free, but they're tax deferred. So that creates, I had a, in that YouTube, I had to go through how to do the math when something's tax deferred for 10 years, because that is a huge benefit. You do have to pay tax at the end, but you don't have to pay tax for 10 years. So it can get really complicated. There are times when life annuities are the place to be. And the reason for that is in the mutual funds, they're going to give you whatever the current rate in the market is. They just move with the market. But banks and life insurance companies, they don't always move with the market. I remember in 2008, USAA had an annuity, an EGA that had ridiculously high yield. And I called the actuary and said, why are you paying that rate? That's higher than what your portfolio manager is making. How can you pay 7% when he's making 5%? That doesn't make sense, right? If you make 5% and pay your customer 7%, you're losing 200 basis points. And they said, well, they're doing it because they're not hitting their sales goal. They need to hit their sales goal for the year. So like, we'll lose money for a month if we hit our sales goal. I said, great, I'm going to buy one of your annuities. Because not only am I getting this ridiculously high rate, but it's tax deferred for 10 years. Yeah, that's a really good deal. So you got to look at all of them. Sometimes banks have some ridiculous CD rates, and you have to really shop around because some banks, I've noticed with this charity I'm working with, we like to ladder our CDs. Some banks, they're really good at 3 months, but horrible at 6 months. Some banks are really good at 7 months and horrible at 3. You got to look around. So mutual funds are usually real similar to each other because it's just what the market is. But when you get outside of mutual funds, you look at banks and insurance companies. There are some times where you get some really great deals. So you should compare them all. But if your uncle comes to you and says, hey, I need to buy some bonds, you say, well, we'll do intermediate terms. We right in the middle. So we don't want long term. We don't want short term. We want intermediate. We want kind of average quality. So that's what these bond funds are. So the only question is, you want tax exempt or taxable, then you get their tax rate and you do this analysis, and it's pretty straightforward. Pretty easy math to do. I used to have to do this at USAA. So I worked with Donna. She bought the bonds for the property and casualty company. And so she would come to me, we had to figure out our marginal tax rate. So I get the marginal tax rate. She'd look at the bonds she could buy, and we kind of decide between us what makes sense. USAA has several subsidiaries. One of them is essentially tax-free. So obviously, if you're tax-free, you don't buy municipal because you're already tax-free. But she had some others that weren't tax-free, so she had to decide where to place those bonds. So it's an important decision. She would make that decision every month for the new cash flow she had. Am I going to lean toward municipals or lean toward corporates? So it's an important decision to make. Municipals have been really good the last few years. Pretty amazing. Not only right now, you can see that the municipal has a lower yield than the taxable. That makes sense, doesn't it? That should be the norm. Not too long ago, they had the same yield. What does it mean when they have the same yield? Same duration, same credit quality, same yield. Something strange is going on. It's like it's pretty obvious that the same yield by the tax exempt. You get the same yield plus you don't have to pay tax. You can't beat that. Really bizarre. Historically, when I was at USAA, you won't believe this, but historically, tax exempts had lower yields than treasuries. That's how much that tax advantage was. The tax rates have come down, but it used to be if the 5-year treasury was 3%, municipals be paying 2.9. Municipals are way above treasuries now. It's hard to see here because of the yield I'm using, but treasuries are much higher, municipals are much higher yielding than treasuries, or even getting comparable to taxables. All right. That's a pretty easy decision. On the exam question, you should probably put this formula in there and explain it. All right, how much time? 3:15. All right. Now structure. So the Bobosi book I showed you, it's probably almost 50% of it's on structure. This is really taken over the fixed income world. I'm not going to cover it much, but if you take John Tui's class, so get into this a whole lot more. It's a huge deal. This is one of those places where if you're working for a firm like Victory Capital or somebody, and they ask you if you want to do one of these specialized bonds, you just always say yes. There's a guy at USA, he's moved up fast. He's probably the youngest senior vice president they've ever had. He's working for me. He's doing great employee. And they asked him to get involved in some of the structured debt. And I said, you got to go. You don't have any choice. That's too important to you. I don't want to lose you because you're a really good worker. I just finished training you for 3 weeks and I'm going to lose all of that. But yeah, you have that kind of opportunity. You have to take it. And he's smart that he took it because it was really, really important to his career. These are really complicated parts of finance. Any one of these bonds is very specialized. You just got to take it because finance pays you for that complexity. You just learn something that's really deep. So take advantage of that. If you see something, go to your boss and say, I know I'm not really qualified for this, but I really want to do that. You just take those plunges anytime you get to do that, especially in your 20s. Because it's too late in your 30s. In your 20s is when you got to pick that specialty. When you get into your 30s, it's too late. You're getting too old to learn something new, unless you're a second, I have students that are kind of going to college a little later in life. Sometime right out of your undergraduate, you got to pick that specialty and stick to it. So we had this term that used to be a popular term. It's not a popular term after 2008, but financial engineering, where the finance world takes all these bonds and kind of packages them up in different types of bonds. And let's take this cash flow and give it to these people. Let's take this cash flow and give it to these people. That's called tranches. You take a bunch of bonds, like a bunch of treasuries or a bunch of mortgage-backed securities or whatever, and you put them in big trusts and you kind of divvy them up to different investors, different types of risk. So you carve out the bonds, repackage them. It's well beyond the scope of this class, but you can make a career out of any one of these things. We talked about some of these: CLOs, collateral leverage obligations. PAC is a mortgage-backed security, but it's to protect you from all that prepayment risk, to protect you from that negative convexity. It still has negative convexity, but not nearly as negative as some of the others. Y'all know IOs and POs we talked about earlier? IO is an interest only, PO is principal only. And mortgage-backed security. You think about that, talk about dangerous bonds. So you have an IO. So all you're going to get off the mortgage is the interest payments. What's your interest payment if they refinance the debt? Just went to zero. That's kind of scary, isn't it? That's pretty risky. And the PO is only the principal payment. So if they refinance the debt, you get all your money right now. So really dangerous securities. My brain can't even think to try to figure out the duration of an IO or a PO. It's really complicated math, but those things are out there. CDOs, collateral debt obligations. That's when banks take their loans to small businesses and things and stick them into a trust and sell those off. We even have CDO squared. We had that bond in 2008, which is a trust that's full of a bunch of CDOs. A CDO is already pretty complicated, because you got to look into the CDO and see all the loans that they have. A CDO squared, you got a bunch of CDOs, and they got to look at everything like CDO, and it's really complicated. The Bloomberg machines we have in FSC will actually let you dive into these bonds and actually see, like commercial mortgage-backed securities. You can actually go on the Bloomberg and see what actual real estate is sitting in that commercial mortgage-backed security. And you can decide, hey, if they don't pay, if they default, how much collateral we have, how much money we're going to get back.
What was the CDO again?
Collateralized debt obligation. And there's a bunch of other alphabets out there as well. So these are complex securities. They usually give you somewhat of a spread just for the liquidity. They can be so complex, not all of them, but They are complex, a little more difficult to manage because they can blow up on you in a really crazy way. Some of them are low risk, like the pack. They're developed to be low risk. Some of them, if you create a pack to be low risk, you have to create a higher risk one. Because if you're going to save these people, the blow ups, then you have to create the blow ups for somebody else. The people who get those blow ups, they get a much higher return. So what the pack does is they get a slightly lower return, but they're protected from prepayments. And then the people like the IOs and POs, they get these massive returns, but they can lose everything pretty fast. So it's financial engineers are just finding a market, creating a lot of fees on the way. So you often get a liquidity premium for these bonds because they can be quite complex. A little bit higher yield because of the complexity. And then inflation. All right, so inflation, bonds hate inflation. If you have a fixed, if you got a 10-year bond that's paying you 5%, you're getting 5% no matter what inflation does. So if inflation goes up, you're making less money on real terms. So bonds don't like inflation. Y'all know the difference between a nominal bond and a real bond. Anytime you see the word nominal, what does that mean?
It's just the interest rate out of.
Yeah, it's the actual interest rate, right? So nominal means your actual interest rate you're going to get. The real rate is the rate you can get, before inflation, minus inflation. So anytime you see real, it's so funny. Corey, who's our graduate, who's making waves on education reform, he's always talking about how much public spending has been on public education. And he says it's up 180% in real terms. And every time he does that, someone says, "Oh, but you forgot to adjust for inflation." He's going, that's what real terms mean. But every single time. So we started joking with him now. Every time he posts anything, "Hey, you forgot inflation." So anytime someone says in real terms, it means if you take inflation out, this is how much it is. So nominal bonds hate inflation. This doesn't really talk to the inflation side, but it talks about a new type of bond that was created called inflation-linked bonds or treasury inflation protected bonds, TIPS. So what these do is they pay a real yield, and at the end of the year, they throw inflation in on top of your principal. So your principal grows with inflation, plus you get a real yield. And it's usually priced off the CPI, the Consumer Price Index. Is that the right inflation gauge? There's articles, every inflation measure is wrong. There's just no way to figure out what inflation really is. So it's theoretical, you just got to kind of guess. But they use the CPI, that's an official number. And so that's what you actually get added each year. It's at some anniversary date. You would think that would have been a great bond to have owned in 2022 with all that inflation, but they actually lost money last year. It's pretty amazing. Why did they lose money? Well, because they started 2022 with a negative real yield, and by the end of the year, real yields were positive. So even though they got all this inflation, the real yield went from negative to positive. So the real yield rose. That hurts TIPS, right? TIPS price off the real yield. They fall in price when real yield rises. Right.
So if inflation was going up and if recession was coming, then wouldn't you want to invest in all them?
Well, the real yield's rising, probably the nominal yield's rising. So non-TIPS, nominal treasuries are going to fall anytime nominal rates rise. No matter what the economy is doing. The treasuries are simple because they're just priced off of interest rates. Interest rates rise, treasury prices fall. With TIPS, it gets more complicated. Real yields can rise when inflation continues. All right, if real yields rise and inflation rise, nominal yields are going to be skyrocketing. Here, the TIP is hurt by the real yield rising, but since you're getting paid inflation, that's a positive to you. So it gets quite complex. And it's pretty amazing. TIPs weren't horrible last year. They didn't lose as much as nominal treasuries, but they did lose a little bit. They was kind of flat last year. They didn't come in as the savior for investors last year. They were just not all that great of a thing. It's amazing to me. I didn't think the 10-year could ever have a negative real yield, because who would buy a 10-year bond with a negative real yield to say, hey, I want to fix in a return that I'm bound to underperform inflation in the next 10 years. That seems pretty crazy, but they actually got to like negative 70 basis points, which is ridiculous. So they're now back up pretty strong. Oh, I always hate hitting escape. So let's just see. So how do you find the real yield? You just go to Google and you just type H15. Y'all know what H15 is? Because I don't have any idea why that works. But anyway, H15. And here's the inflation index yields. You can see right now for the 10-year, it's 1.94. That is the real yield in the United States, 1.94. So you'll get, if you bought a 10-year TIPS today, you get 1.94%. And in every year you get inflation added to it. So that 194, I don't know how low it got, but it was at least negative 0.7%. So you would have gotten negative 0.7% plus inflation, which means you would have underperformed inflation. The 5-year got, oh, ridiculous, like negative 150. It was just, I may have gotten as low as negative 2%. You would have been really horrible investment. So these are the tips, 5-year, 7-year, 10-year, 20 and 30-year. So they're up close to 2%, which is pretty powerful, pretty decent. What should the real yield, your money and banking class be talking about that? What should the real yield in the United States be? A lot of debate about that. You probably had some theories, right? We're doing like Fisher and what else? I haven't had money in banking in 40 years, so I don't know. But those theories, important theories, some of them have kind of broken down in the last few years, and we're kind of in no man's land. Oh wait, where did I go? Okay, let me find. So if you're really worried about inflation, you would think TIPS would be the place to go. I think right now we probably are correct with that 194 or that 200, a 2% real yield. You're getting some pretty good protection from inflation. So if you're really worried about inflation, yeah, at the end of 2021 with real yields so negative, doesn't make a lot of sense. I used to run USA's 401k plan, and when I left, we had 13 options. I took it from 3 to 13. And when I left, that department had a couple more, and they added an inflation protection portfolio. And so I go, hey, Jason, what are you putting in there? Oh, we're putting TIPS and REITs. I said, TIPS, you know the real yield is negative right now. So if you buy TIPS, you're guaranteeing them that they underperform inflation in a fund that you said is inflation protected. And how do REITs do when inflation takes off? REITs hate inflation. Why is that? Because they have high yields. What do interest rates do when you have inflation? They rise. If REITs are considered a bond substitute, they fall in price when interest rates rise. So it's like you have two things in your inflation fund that are going to do really hard, terrible if inflation takes off. I was scared to look at the fund in 2020. Can you imagine people in 2022? Hey, I've got this inflation protection fund. How'd you do? Over down like 10%. It's like, okay, someone messed up there. Inflation is a really tough thing to protect yourself from. It's just really tough. Last year, what could you done? You could have bought oil, could have bought Exxon, could have bought Valero, but TIPS would not have been your protector. One thing I love about TIPS is they tell you what the bond market expects inflation to be in the future. I have a YouTube video that shows you how to do this. Elizabeth knows how to do it, right? Remember my P&C class? Remember from last semester we did bootstrapping the yield curve? It's been a little long, but she'll come back to her. Bootstrapping the yield curve, you can use the yield curve to predict interest rates, to predict inflation. So right now you can go and ask, what does the bond market think inflation will be in 6 years from now? That's a pretty powerful thing to know. And if you disagree with them, you can do a trade to bet against that. So you can watch my YouTube that shows you how to do that. Really powerful stuff. It's also going to tell you where they think nominal rates will be in 5 years. So if you want to know what the 10-year yield is expected to be 5 years from now, you can go find that by using bootstrapping the yield curve. Pretty powerful stuff to do. So I think I'll link the YouTube in the class notes. So you can click on it and look at it. It's pretty useful stuff. I still remember the day I was minding my own business, working in my office, and I get a phone call, pick it up, and it's the CEO of UTSA. So he's calling me. That's kind of dangerous. He's in a room with 30 accountants, He goes, Ron, no one in this room knows how to bootstrap the yield curve. Do you know how to? I would have said yes, even I didn't know, but I did know, fortunately, because I'd just taken the CFA exam. But yeah, I can do that. Says, yeah, how come they don't know this? And I can say we're all accountants, that's why, but I didn't say that. But yeah, I mean, he's just like bootstrap yield curve. That's a good way to predict where interest rates are going, or at least what the bond market thinks. That's a good place to go. So learn how to do that. Bootstrapping yield curve is a powerful, powerful thing. You might find your first job, they don't know how to do that. And they're asking you for an inflation forecast or an interest rate forecast. And the first thing you can say, well, why don't we just bootstrap the yield curve? That's going to sound pretty impressive, isn't it? Okay, what do you mean? So, but make sure you know how to do it before you just bring that up. All right. So practice it. It's a pretty simple thing to do. In fact, one thing I would do, I need to set this up again. I had it at USAA, but supposedly Bernanke, and I don't know about Powell, but Bernanke and I don't know when tips have only been around since the last 20 years. So so Fed chairman before him, but Bernanke definitely watched the forward inflation projection in the tips. And supposedly, if that number got above 3%, if the bond market was expecting inflation above 3%, he was definitely going to be raising rates. And so you can set it up. It's pretty easy to set up an Excel spreadsheet and just look. It's called the break-even forward inflation number. And what they mean by break-even is it's the inflation number 5 years from now where you're indifferent between buying a nominal bond or buying the tips. And so that's that break-even. When that number gets above 3%, the bond market's saying we're worried about inflation. Now that's 5 years out, right? So it's a good chance that number is still below 3% because 5 years out, the bond market still expects inflation to come down. That's a great number to have just to be monitoring, and it's really easy to set up. Once you get the formulas are not that tough. They're pretty basic formulas. You get that set up, you can put it in a spreadsheet. You can just quickly see what the forward rate is. All right, put that in the wrong spot. All right, so DC cuts I. So US versus non-US, that's the U. The big issue there is what? Currencies, which is inflation, interest rates. T, what's the big issue there? Marginal tax rate and that relative spread. S, not much to say there other than just define it. There aren't subcategories there. It's just a category that's important that you be aware of. And then I is pretty simple. It's either non-inflationary linked or inflation linked bonds. There's no other categories. Are there any other inflationary linked bonds out there? Supposedly the UK has some, Australia has some. I think Australia's had them for decades. UK may have had them for decades. So there aren't that many out there. There aren't really a lot of corporate bonds that are inflation linked. But in my prep and casualty class, I gave them an idea how you could actually create an inflation linked corporate. You would buy tips, short treasuries, and buy corporates. And if you did that, you should end up with an inflation linked corporate. It's an interesting asset class. I went to an inflation conference. They actually have an inflation conference. It's a bunch of economists. I understood 2% what was going on there. Pretty complex. But Milton Friedman spoke at that conference. Can you imagine? I didn't get to meet him, but I got to see him from 50 yards away. But Milton Friedman, pretty amazing. I understood his speech. Like I could listen to him the entire. They should have just had him come in and speak 2 days. Really impressive. But they had a person from the Federal Reserve, the federal government, come in. And at that point, the U.S. deficit was so small, they eliminated 30-year treasuries. I'm going to ask them, is the U.S. government ever going to have 30-year treasuries again? He says, no, our deficits are so small, we don't see a need for that. But we've solved that problem. That's not an issue anymore. We have plenty of 30-year treasuries. But one thing he said I thought was really interesting is when tips were first offered, the bond market wasn't really buying them. They're really nervous about them. And so people went to the Fed and said, will you buy some tips? So the bond market knows these are normal bonds. And the Fed said, our job is to protect, keep inflation under control. What will it look like if the Fed is buying inflation-linked bonds because we're worried about inflation? I mean, it was like the signaling would just be horrible if the Fed starts buying tips. Because they're like, we're not going to do that. You're on your own. So it's an interesting bond. If you want to really freak out a bond person, ask them what the duration of a TIP is. Complicated problem. Y'all remember Dee Dee I talked about? I did that with her, and I had her. I messed up her entire afternoon. Like, Dee Dee, how do you figure out the duration of a TIP? So you'll see when we talk about duration a little more, you can see it's a very complicated formula because you have the nominal yield, you have the real yield, you have the inflation. The nominal bond is pretty simple because you only have one interest rate. With the TIPS, it's really, in fact, someone Google it. What is the duration of a TIP? And you'll see probably a million college articles come up. There's probably a lot of PhDs doing their dissertation on that. It's a very complicated topic. All right, so where are you now on bonds? On a scale of 1 to 1,000? How would you grade yourself? Are you higher than when you started the class? Hopefully. So I'm still around 0.1, 0.2, somewhere in there. Fixed income is wonderful. Everybody wants to do stocks. That's fine. Boring. Fixed income, there's so much to work with. There's a lot more quantitative to work with because you have interest rate theory, you have inflation, you have all these things going on. You have normal credit analysis, but you also have duration, convexity. So if you're more quantitative, fixed income just gives you a whole lot more to work with than stocks do. But let's start talking about stocks. So when you get to this part of the paper or your essay, you need an introductory to stocks. And there's a few things that you need. I think this is really important that you need to be able to succinctly explain what a stock is. So when you're talking about a stock, we're talking about ownership. You're actually an owner in a company. So if you buy some Apple stock, you are one of the owners of Apple. You might be a 0.000001% owner, but you are one of the owners, which means you get everything that's left over. You're the residual owner. So after they pay all their debts, pay their employees, their vendors, you get everything else left over. The wonderful thing about it is you have unlimited upside and limited downside. You can only lose 100%. Now you might say, well, duh, but that's actually a pretty unique thing that we've set up in the United States and in the developed world is this idea of limited liability. It could be, and there are firms that don't have limited liability. If you ever heard of Lloyd's of London, in Lloyd's of London, you invest there and they really mess up, they're going to call you and say, hey, you're one of the owners. We've run out of money. You got to give us more money. Would you do that if you're buying Apple stock? You invest $1 million in Apple stock. Hey, we had a really bad year. You got to give us an extra $1 million. And you're still only worth $1 million. We wiped out the million you gave us, but you're required by contract. No, you wouldn't do that. But in the U.S., you invest in the firm and they mess up, they get sued. They got these massive $1 trillion lawsuits. You don't care. So I lost 100%. That's the most I can lose. They can't call you and get more money. So that's, some people want to actually undo that. Some people think that's the key to capitalism working so well. That's why people are willing to take the risk, because at least you know you can't lose more than 100%. Same thing with the bond investors. They can't lose more than 100%, but they have a fixed return, so they can't make more than 6% either. You have a 6% bond, that's the most they're going to make. So they have limited upside, limited downside. Their downside is the same as the stockholders, 100%, but at least they get paid before the stockholders. So they're more likely to get money back than the stockholders, so they're a little protected. But a stock investor is really great. You get all the upside, and at least your downside is limited to 100% loss. So it might be a big part of why our economies work so well. So here's the real key for stocks. When you buy a stock, what are you buying? And that's what you're buying. You're buying a current dividend yield plus expected earnings growth. That is a stock investment. Real simple, a lot simpler than duration, convexity, and all that stuff. That's it. The current dividend yield you can go look up. So it all comes down to earnings growth. When you're buying a stock, and you're going to see this in paper 2 when we talk about the earnings announcement. It's all about earnings growth. I don't know what NVIDIA stock did today. Where are they today? I know Oracle had some bad news last night. Or tech stocks down today. And why do tech stocks drop or go up? It's that expected earnings in the future. How far out into the future? for infinity. I don't know when Walmart's gonna go out of business, but as far as I know, it's infinity. Why is infinity okay? Well, because when you take in the present value, 1,000 years from now is worth zero today in present value terms. So you just go out to infinity and it doesn't really matter. I hope Walmart goes out of business. I hope Amazon goes out of business. I hope Apple goes out of business. I hope a better firm comes along and does better and puts them out of business. That's for me as a consumer. I want business to go out of business. I want a better player to show up. But as an investor, not so much. I'd rather they do great and take over the world. So the key here is, what can you expect out of these stocks? So let me start off with just this theory I just told you. The stock market gives you a dividend yield plus earnings growth. I don't know how you're doing on time. I'm probably going to do this twice, but this is a complicated chart. So I've always believed that the stock market gives you a dividend yield plus earnings growth. So I decided, well, why don't I just graph that and see if it's actually true? And so what I did, I went back to 1871. Anytime you see 1871, what name comes to mind? Robert Shiller. So look up Robert Shiller and do Robert Shiller data. He has an Excel spreadsheet online you can get for free. He takes the U.S. stock market back to 1871. And he's doing the S&P 500. The S&P 500 doesn't go back to 1871, but his data does. I don't know what was in the stock market in 1871. Maybe some banks, maybe some railroads. I don't know. Can't be too many publicly traded funds back then. But anyway, he somehow figured it out back to then. What I did is I took his data, I took each decade's dividend yield and each decade's earnings growth, and I just graphed it in the red line. So that red line is growing up by the dividend yield and the earnings growth for each decade, right? And then the blue line is the actual return on stocks. So if you look at this, they tracked pretty closely, didn't they? And then you had the roaring 20s. Stock market got ahead of itself, and then what happened? Great Depression. Then it kind of moved pretty closely. Then you had, post-war and the roaring 60s. Then you had the horrible 70s. Stayed with it pretty well. It came out of the 70s. The Fed fixed all the problems. Inflation's down. Interest rates are down. The stock market took off. There's the dot-com bust. Why do you notice what dot-com bust? Didn't get back down to the red line. We recover from that. What is this right here? 2008. We got right back to the red line. What's happened since then? Looks overpriced. So it's either overpriced or it's not, and I can give you a couple of reasons why it may not be. So I'm not arguing the stock market's overpriced, but you could look at this and say that it is overpriced. But next class, I'll give you 2 reasons why it may not be overpriced. All right, let's start. So it's the fall semester, so this is when you're interviewing. Hopefully you got a lot of interviews set up. There's a lot, these aren't related to finance, but there's a lot of companies coming to campus. Valero was here last night, and they're coming again next week, or is it like tomorrow or today or sometime? USA, we have an October 5th day with USAA. But this is it's these next 2 weeks that are huge. So how many companies should you interview with? How many hours do you have in a day? I'd be applying to 10 to 15 companies every day online. So it's constantly going. I'd take the Russell 3000, organize that by sector, rank it by market cap, and I'd interview with the largest 15 companies in every sector, in every industry, and just online. I don't know how long it takes to apply online, but if it takes 5 minutes, then 10 a day is going to take you about an hour. It really is a volume thing. And a lot of speakers are, I got to figure out what I want to do with my life. Well, you'll figure that out in about 10 years. You're not going to figure that out now. Right now, you just got to get someone to offer you a job. And then once you get experience, then you can start making decisions. But you just got to apply. So make sure you're doing that right now. I didn't do that. But fortunately, the firm I interviewed with didn't do that in the fall either at that time. And so they didn't have much choice in the springs. So they interviewed in the spring. I interviewed in the spring. So it worked out really well. But now they don't interview in the spring at all. They only interview in the fall. So it's pretty common that you don't see people again until the next spring. A lot of firms do interns. So if you're a junior, you'll be a senior next year. You definitely want to be thinking an intern for this next summer. usually your intern after your junior year, you're hoping is going to be a full-time offer. So, that's the key. We just saw Tomas last night. Tomas got into the intern program at Valero, and then he crushed it. And so they hired him full-time. So he's been there 3 years, but you think he's been there 10 years. So that can be pretty important. It's real important in investment banking that you do that. So if you're trying to get Citibank or JP Morgan or Bank of America, you really have to do an intern with them summer after your junior year, because they probably offer 90% of the interns a full-time position. And they'll do a little bit more hiring, but most of the people they're hiring are their interns from that summer. So this is the time to do it. We didn't do interns when I was in college. It just wasn't the thing. But then I was a music theory major, so it was kind of a little different. But yeah, today it's really, really critical. So interview a lot, and think in terms of volume. That way, if you get turned down 20 times, it's a big deal. I applied to 100 places. Now, if you get turned down 100 times, yeah, you get kind of a problem. But if you apply 3 times, you get turned down 3 times, they're like, wow, what a failure I am. Well, no, the failure rate is really high. It's just the nature. It's very competitive, but it's very competitive both ways. Companies are very competitive to get students, and students are competitive after jobs. Firms are hiring, but there's a lot of people applying, there's a lot of people hiring. So you just gotta hit the right place at the right time. So yeah, you may interview 10 places and only one of them calls you back. You interview in 100 places and 10 of them call you back. Now you got 10 options. So it's just volume. Increase as much as you can stand it. It's not fun though, right? Interviews are not fun. But after you've done 20 or so, you're kind of going to do it in your sleep, and you just kind of start talking. All right. Okay. So today we want to do a team question. So far we've said someone walks in with some money, say, oh, you want to create an investment portfolio. Let me tell you what an investment portfolio is. You explain that. Say, so I'm going to help you out, but I have 3 questions for you. You've got to figure out why you're investing. So you go through that horizon thing. We got to figure out what we can invest in. Here's the asset classes I use. Is there anything in this asset class? Can you do emerging market stocks? Can you do this? But these are the classes I use. And then, okay, once we figure out what we're going to do, now we got to figure out how to execute this. We got to get a strategy. We got to then figure out how much work you're going to put into it. How confident are you? If you don't know much about this, we'll probably just go to Vanguard and stick you into one of our funds, that kind of things. So if you've done that, now you're going to delve into that second question. What can you invest in? And you're start off big level. Let me explain to you just high level the major asset classes. All right, we'll delve into it in more detail. All right, so you see how you're walking them through. I kind of do it in my logical way. You might do it in a different way. Some students do question 1, question 2, and then do the major asset classes, then all the detail, and then they throw a question 3 at the very end. Except for then they forget to do question 3 and they lose a question. Oh, I forgot to put that in there. So you could do that. I'm more do the 3 questions and then say, hey, let me delve into that second question, because that's really where all the work is. So what you're going to do today is just that high level major asset classes. Now, what's the key in that one? You got 4 of them, right? But the first 2 are exactly the same. So you got to distinguish between those first 2. So that's really what it is. What are those asset classes? How many are there? 12 major asset classes? 4. All right. And the first 2 are really the same thing, but we distinguish them because they have some unique characteristics. So that's what I'm looking for today, with no notes, no computer, off the top of your head. You got to know it off the top of your head anyway. All right. So you can figure out how you can organize it. So you got to write it somewhere. So, all right, go. So hopefully you're writing out your first answer. It'd be probably next week when we get into that second question on how you apply all of this. But so I think it's a really good template. I can't think of anything major I've left out. Obviously, on structured debt, there's so much more you can go deep into. We mentioned last class, we're talking about inflation. I just want to show you, this is something you should probably set up. So I brought in the 10-year treasury nominals, 5-year nominals, tips, 10 years, tips, 5 years. And you can do the forward curve. So that video that's linked in the notes shows you how to do the forward curve. I would just automatically start following this every day so you can kind of see what the market's thinking. And when you do that, you get what's called the forward break-even inflation number, which is an incredible number. So before we had tips, we couldn't do this. So before we had tips, you could ask someone, what is the real rate of interest? We actually didn't know what the number was. So a lot of people think, well, It's nominal interest rates minus inflation. Well, that's not quite true. So if you go to like 1985 and get, okay, the nominal yield is 8%. Inflation was, well, inflation when? Oh, the last year. Well, that's not what the real rate is. The real rate's not nominal rates minus historical inflation. It's nominal rates minus expected inflation. Where do you go to get expected inflation? Doesn't exist until now in TIPS, right? So TIPS tells us what we think inflation is going to be, but why do we use the forward number? So this is what the bond market thinks inflation is going to be in 5 years, in years 6 through 10. Why do we do that? Because the current number is too noisy. We got a lot of stuff going on. You have high oil prices, whatever. Inflation's up and down in the summer. So what this does, it takes all the current noise out and lets you know what does the market think long-term inflation is going to be. And you look at this number and you notice it doesn't really get above 3. Even here recently, with all these inflation scares, the bond market never said they thought inflation is going to be above 3% 5 years from now. Now, why is this an important number? This is the number when I went to that inflation conference. This is the number they said the federal chairman watches this number, and if he or she sees it jump above 3%, they get really nervous. If the bond market start thinking about inflation is going to be a problem, the bond market, you have to listen to the bond market. Have y'all heard the term bond vigilantes? So the bond market, if they're not happy, nobody's happy. And they have a right to say that, right? People are mad at them. I've heard some government say, you know, this bond market, they're so cruel. And it's like, hey, we loaned you money. You wasted it. We want our money back. Why are you mad at us? You know, it's our money to begin with. But the bond market has a lot of power. They somewhat dictate what's going to happen because if they're not happy, they don't have to lend any money to anybody. You know, Argentina is going through that right now. You don't have to loan you money. It's like, give us money, give us money. We're going to mess up and give us money. It's like, no, we don't have to. So the bond market gives you a pretty good indication of what it thinks inflation is going to be. So you can see it's gone up, but it hasn't been just crazy high yet. So if we get it to the 3%, the Fed is going to get pretty nervous. And why is that? Well, inflation is an interesting number because it's psychological more than anything else. So when inflation takes off, what do people start doing? So you're worried about prices really rising in the next few months. What will you do? You're going to buy now, which is going to do what the prices? Cause them to go up, which is going to make people do what? Buy more now. It's an incredible cycle. It's really hard to stop. Or if you're deflationary, you're expecting prices to fall the next 6 months, what do you do? Say, oh, wait, you're going to buy a new refrigerator. I think prices are going to drop 10%. You know, like used cars, you saw them go up, and what do people do? They started buying used cars really fast. And now people are probably saying, you know, the price is coming down, I might wait a while. So inflation perpetuates itself, and the Fed has a tough time solving it. They say it's easier to solve the inflation cycle. You just cause a recession. There's been debate about deflation. What happens when people are just not spending because they think prices are going to fall? Bernanke has a famous quote. Y'all know his. Why is Bernanke called Helicopter Ben? Have y'all heard that story? So they asked him, how do you solve the deflationary? He said, well, I'll just get up in a helicopter and throw money out. You know, just create a lot of money supply. That was kind of, so he got that reputation. So the Fed watches this number really closely. The Fed watches this number really closely, then you might want to watch this number really closely. It's really important. Now, why does the Fed look at core inflation? So core inflation excludes what? Food and energy. Why do they do that? I've heard people say it's because they're the most volatile. That's part of it. But I also think they're also deflationary. Because if oil prices go up, gas prices go up, what do people do? They got to keep driving. So they got to cut back on other things. If food prices go up, they say, hey, food prices up, we won't eat for the next 3 months. That's probably not going to happen. What's going to happen? They're going to buy more in food. They're going to have to spend less on everything else. So high oil and high food prices tends to be deflation or everything else. So that's kind of double reason. So inflation is a really important number. It's a really tough number to manage as well.
So there's deflation.
Well, so one of the most famous formulas in finance, I mean, in economics, this is my favorite. I love formulas that are simple and tell you everything. So you're probably doing this in money banking. So y'all tell me this formula. I always mix the letters up, but Y'all remember that formula? Are y'all doing that in money invention? NV equals PQ. What is all of that? All right. P is price, inflation. Yeah. Price times quantity gives you what? Velocity times money supply, right? Really important formula. So Jerome Powell got in a lot of trouble a few years ago because people were saying, hey, the money supply is so high. Aren't you worried about inflation? He says, no, it's been high and there's no inflation. Why didn't we get any inflation when the money supply was so high a few years ago? During COVID, all this money supply, but we didn't get any inflation. Well, there is no velocity. People's like, okay, you sent me this check, government, for $1,200, but I can't go to the restaurants, I can't go to the movies. You know, what am I going to do? I'm just going to put it in savings. So you had a high money supply, but what didn't you have? No velocity. And then suddenly what happened? We came out of COVID. Suddenly people were going back to restaurants or buying stuff. Suddenly what did you have? You had velocity. So P times Q, price times quantity. If you don't have enough supply, which we didn't, right? Got a supply chain problem. So you have a lot of money, a lot of velocity, but you don't have the quantities. What's got to give? Got to have inflation. So don't y'all love this formula? It tells you everything. And so Jerome Powell said, I'm not worried about this because we've increased the money supply and nothing's happening. Yeah, that's assuming velocity never changes. When velocity changes, suddenly got a major problem unless people can start producing a whole more stuff. But right in the middle of this high velocity, suddenly we have these supply chain problems because of Putin and others. So yeah, I love this formula. So yeah, Emmanuel, I think of inflation in terms of this formula. It's really, really powerful formula. So yeah, so in a deflation environment, you throw all this money out there, but what are people doing? Like, I'm not going to buy anything. I'm just going to stick it in my savings account. Well, you're not going to get what you want. It's just going to be a recession with people with great savings accounts and not all that useful. See why money and banking is so important. I think last night Tomas said, actually he kind of played to this class, but he said, yeah, what happens the first Friday of every month? So he's talking about these important economic things he's looking at, like the employment report, but PQ equals MV is an important one. All right. So last class, I was talking about this important concept of stocks. When you buy a stock, it's a dividend yield plus earnings growth. Pretty straightforward. And so I mapped that out. So I want to argue so the stock market could be materially overpriced. Why might it not be? And I'll give you a couple of arguments why not. Number one is expenses. It's much cheaper to buy stocks today than it's ever been before. So you might not believe us, and I'm not using inflation. These are actual nominal numbers. In the 70s, if you wanted to buy a stock, it was $40 per trade. Can you believe that? So what is it today for commissions? Zero. Back in the 70s, it's $40. That's a huge, that's negative 100% inflation. Went from $40 to free. Information. Back in the 70s, if you want to know what a company was doing, you'd have to wait 3 months for them to mail you the annual report. And then what do? You read it and you want to do some analysis. How do you do that? You get out your TI calculator, you get some paper and you write it down. There's no software, there's no spreadsheet where you type stuff in. The information came really slow. What about the internet? Internet in the 70s, how did that work? There's no such thing. So yeah, there's stuff I do in class that if I'd done it when I was in college, it would have taken me several years, and I'll do it in 30 seconds in class. And getting the daily S&P numbers back the last 60 years, when I was in college, there were books in the library that thick with the stock prices for all the stocks. All you had to do is you get the book out, you go spend 10 cents a page to print all the pages, and then what do? There's no place to put the data. You can put it in calculators, but then it's just ridiculous. Today you can do all of that in nanoseconds, and it's just amazing. So that information, it's not just as cheaper, but we have access to it really just everywhere. You can bring all this data in. It's pretty amazing. So I think the fact that it probably used to cost you 3-4 times more to own a stock than it does today, you're getting a higher return just because it's so much cheaper. And so the market somewhat has adjusted to that. That doesn't mean you're going to keep getting that gap. It just means you got that one-time big gain because everything's cheaper and then it just kind of go parallel. The other part of this is somewhat related to that, and that's risk. Because we have access to so much more information at our fingertips real quickly, risk is much lower. We know our companies, we can move much faster. So risk is lower, so the discount rate's lower. So we had two things where expenses is lower, so you got that big jump in return. Risk is lower, so your discount rate's lower. So it doesn't mean we're going to keep going wider, but it just means we have this one-time adjustment, and then those two lines should go parallel going forward. Now, does everybody believe that? No. There are certainly people out there who don't. But if you type Robert Shiller data, and it's right there, the CAPE ratio. Have you heard the CAPE ratio? We're fetching your file. Who's writing these websites? Fetching your file. Wow. Okay, I wanted it to go to Excel. So how do I get it to download? Now this is a whole new link. Okay, sorry, it's online, but so this is the CAPE ratio, and what he's showing you, the blue is the stock market, the red is the bond market. And you have to think backwards. So when the red line is low, bonds are expensive. The blue line's high, stocks are expensive. All right. So you can see, I think that's the .com. So here's the .com crisis. That's probably the most overpriced stocks have been in the US, but they really weren't that overpriced. There was a small handful of stocks that were grossly overpriced, and a lot of stocks were actually okay. There was a lot of stocks that did okay in that major crash because they didn't get that expensive, but a small number of stocks are grossly overpriced. So that's the most expensive the stock market has been. And then you see going into since 2020, I can't tell what date that is. Going into 2020, stock market was more expensive than the 1920s market. That's pretty amazing, isn't it? You think of the 1920s as a grossly overpriced stock market. Robert Shiller says our US stock market was more overpriced in 2019 than it was in the roaring 20s. And then we corrected back down. So stocks are not cheap by that chart. They look really, really expensive. All right. Bonds got ridiculously cheap in 2020. That's when I was shorting the bond market because it was just like ridiculous. We're having a big debate in the investment society. How low can the 10-year yield go? And I shorted when it hit 50 basis points. People were saying it could go to 25. And I was like, that's not that far. It's going to bounce off. I'm going to short the market here. You can see bonds now are actually pretty decent according to Shiller. They're kind of back to more normal times. How well does this work? You're not going to make money betting on Shiller because he's had the stock market overpriced for an extremely long period of time during some really, really good bull markets. So you would have lost a lot of money. But he does show the stock market is overpriced, but not as bad as it's been. Definitely not as bad as it was back here. And we're essentially below the 20s, but not much. So he's showing it pretty expensive. But bonds are right in line with kind of the historical norm. So are stock overpriced or underpriced? Yes, they are. No one knows. There's no obvious way to figure that out. Depends on your growth rate, your risk assumptions. There's all kinds of things. So I think you could justify that this market's not overpriced, but who are the people who are adamant and on the other side? Jeremy Grantham. What's word you see there is doomsday prediction, which is really smart to do. You should predict a doomsday market crash. You can do it for like 6 years in a row, and when it happens, they think you're a genius. So all you have to do is just keep predicting it. It's just around the corner, and when it finally happens, you'll be on CNBC, and they'll be interviewing you for the genius you are. But he's very, very, very negative on stocks right now. Is he right? Who knows? He looked kind of right in 2020. The market fell 20. The problem is he was saying the market was going to drop more than 50. So he hasn't been right about it dropping more than 50 yet. So he's pretty stern. I highly recommend his website, gmo.com. Really good website. You have to register to use it, but it's free. Some of the best articles in finance from that site. I would just get in the habit of reading all their articles. They do some really good stuff. One thing wonderful about those articles, you're interviewing for jobs. They sometimes ask for an idea or some perspective. I remember in well, I don't know why my firm hired me. I was a horrible interviewer. It was pretty, they asked me one question. I completely misunderstood the question. My answer was so stupid. I remember Pat was there and she said, no, what he meant was this. I was like, yeah, that's what I meant. She saved me, or it would have been a disaster. But they asked me that question, what do you think is the most important issue right now? Or what ideas do you see, what's right, those kind of things. GMO will give you some great ideas to throw into an interview where you won't sound like an undergraduate student. Right now, their big thing, they're talking about growth versus value that we're going to talk about. I might show you some of that article. Why are they so big on value stocks right now? Why is that idea? So you're looking for something that you can talk about. You might have to give him credit, which would be okay. I was reading some articles on GMO site, and I really like their ideas. At least give them credit so it doesn't sound like you're plagiarizing. Then they'll be impressed that you're reading those kind of websites as well. But really good website. I'd get in and show you, but I have no clue what my password is anymore. Let's see if maybe it doesn't require yeah, it does. There's a login. But there it is, GMO research. Look at this article right here. Look at that title of this article right here. What does it say? Value does just fine in recessions. I'm going to talk about why they're saying that, because we're going to talk about value versus growth and why value traditionally is supposed to be the place to avoid in a recession. They're saying, no, not so true, Professor Sweet, you got that wrong. That's fine. They're arguing against convention, but you get their perspective. All right, so if a stock gives you a dividend yield plus earnings growth, how fast should corporate earnings grow? And I'm going to argue that corporate earnings should grow somewhat in line with the growth in the economy. My argument is if the economy grows 5%, but corporations are growing at 12%, in about 30 years, there will be no consumers, no governments. We'll just all be corporations. I don't know who their customers are going to be because there won't be any consumers. So corporates can't grow materially faster than the economy without taking over the economy. It's just mathematics. It's impossible. Now, it might say that can't be possible. Obviously, corporation earnings grow a lot faster than the economy. Well, I'll see if I can prove that wrong. So corporate earnings should grow in line with the economy. So here's the chart. I love these charts. Anytime I hear some convention in finance, I like to go back and map it out and see, is that actually true? So here, the green line is actually the growth in our economy. All right. The red line is the growth in corporate earnings. And what do you notice about the growth in corporate earnings? How often in history have they grown faster than the economy? They can't do it. A couple of years ago, they actually caught up with the economy for like 37 minutes, and now they're back slower again. Now, 2008, that's the accountants. That has nothing to do with finance. What did accountants do to us in 2008? Why did earnings drop 90-something percent? Y'all know what happened in 2008? It wasn't a recession. What did accountants do? Well, fair market accounting with the bonds, right? So what is fair market accounting? You market bonds to market. When bonds, like USA, we had bonds falling 15%. 15% of $30 billion. It's hard to make money when you're writing off that much money all at once. So actually the USA Life Insurance Company, their bonds fell so much in value that their entire net worth was eliminated. They had no net worth. It was huge. So you should know as finance majors, there's some important FASBs out there that you really should read. I can't remember the numbers. It's FAS. I can't remember it. But y'all should know this. It's really important stuff. Let me find it for you because you really want to. Oh, wait. What did I just do? Sorry, I didn't mean to do that. So, I think what's frustrating to me is This is so critically important. I ask seniors in finance, did you cover this in your accounting class? And say, no, we didn't cover it. It's like, you gotta be covering this. Really, really important. So which FASB is it? Does it put it? FAS 157. Y'all studied level 1, level 2, level 3 assets. Does that sound familiar? Anybody who's heard of that? Here, Kyle, did you hear it in class? So really, really, really critical that you understand this. I was running mutual funds in 08. So what is level 1, level 2, level 3? Well, level 1 assets are assets that have an easy market price. Those assets, accounting says mark them to market. You can go and get a price like a stock, market to market. Level 2 is when you have some pretty good idea, like some model or something.
Same thing.
Well, M1 and M2 is like money supply. Yeah. This is level 1, level 2. This is a little different thing. Yeah. I don't want to subscribe to anything. So level 2, these are less liquid assets. They don't have a ready market price, but there's models. Now you might think stocks and bonds are in level 1. Stocks are definitely in level 1. Bonds aren't always in level 1. There's a lot of corporate bonds rarely trade. So it was hilarious and not hilarious. It was sad in 2008. So in 2008, you call your broker because you got to price your bonds. You say, I need a price on this bond. They'll say it's trading at 96. 96, okay, good. We lost 4%. That's okay. We'll put that on the books. You go back to your manager, say, oh, we can put that at 96. 96? Oh, I love 96. Let's sell it at 96. So you call the broker again, say, hey, we want to sell. Oh, you want to sell. You want that price. That's 80. Like, what? I thought you said 96. Well, 96 is the model price when you stick it in our model. But if you actually want to sell it, it's 80 because there's no buyers out there. All right, so you're a mutual fund, you got to put a price on your bonds. Do you use 96 or do you use 80? Well, if no one's ever traded, you can use 96, but guess what? Someone in Iowa trades $1 million at 80. Guess what you have to do now? You now have to write it down to 80. Why? Because you now have a price. That was what was going on in 2008. I was over equity, so I was like, I don't care. I was on the committee for valuations, and we used to meet like, I never met at all in the previous 2 years. And then suddenly in 2008, at the end of the year, we're meeting every day. We got a bond. It looks like it's down 40%. We have to write it down. We had to make a decision. And I'm just sitting there like, I don't care. I'm equities. But they had to make a decision. How much do we write it down? You got to justify it. The SEC can come in and challenge it because obviously you could be distorting it. This is really critical. If you're working for a financial services company, a bank, an insurance company, this is really critical to them. They also have y'all heard this? Y'all heard of Silicon Valley, haven't you? Yeah. So what was their problem? So have you heard of AFS, available for sale bonds? So what's the other side? Available for sale, and they have the other side up there. Held to maturity. Right. We should have an accounting class where they just teach this stuff because it's really important. Where are you going to get this stuff? You're going to see it on the CFA exam, definitely. So held to maturity bonds are bonds you say, hey, I bought this bond, we're not selling it. And so they kind of say, okay, you can put it at book value. You don't have to market the market because you're not going to sell it. So if it falls 20%, you can keep it at the price you bought it, minus amortized. Available for sale, you have to put it at market price. So what does an insurance company want to do? They want to hold maturity, so don't have all that volatility. Well, the problem with the accounting is, are you really going to hold a maturity? And the bond guy says, well, I'm going to hold a maturity unless it's credit quality falls. And they say, no, that's not held maturity. Held maturity means you're going to hold a maturity no matter what. Now, you as a bond investor, you want to say, I don't care what happens, I'm going to hold this thing to maturity. You never want to say that. So now you get this problem of, if I hold it held maturity and I change my mind, what happens? So let's say you got $5 billion held maturity, and there's one bond in there you want to sell because it's got a problem. Guess what happens to your entire held maturity portfolio? It all suddenly becomes available for sale. So you can see the stress of 2008 for these poor bond guys. I've never seen bond guys stressed. They're usually pretty, like, their lives are really easy. My life was stressed in equities, but not nearly as bad as theirs. It was a pretty bad year. I don't know where available sell, which FASB that is. But so what did I say? What was the other FASB? Was it 115? I'll write that down. And so the available sell is another FASB you should know. if I were interviewing with a bank or insurance company, I would make sure to read at least the Investopedia of these things. These are pretty important. So like Elizabeth, you go to the life actuarial side. It's funny, life actuaries understand this better than finance people. Because this is huge to what they do with annuities and other investments. It's a huge part of their lives. So anyway, a lot of stuff out there. So that's what happened in 2008, that available to sell. Insurance companies and banks especially insurance companies, had to write these massive bond portfolios down, billions and billions of dollars. And then what happened in 2009? They all came roaring back. So it was that one massive drop. Did the market worry about that? They didn't react because of the market earnings drop, because they so that's just the accountants. They were reacting to other things. Since then, we've come back pretty strong. We've been kind of all over the place. You can certainly see COVID in there, right? When United Airlines sees their revenues drop 90% in a year, that's kind of unexpected. You're not going to make a lot of money when that happens, but we've come back pretty strong. Our earnings growth has been pretty strong here recently, but not as strong as the economy. It's still not as strong. The other lines I have in there, one is 5%, which is kind of my bottom line. And then the greenish one, that's kind of between, that's the yield of the 10-year treasury. The reason I put that is Dr. Mortaram from MIT and the New York Stern, he says the best estimate of corporate earnings growth is the 10-year treasury yield. So I stuck that in there so you can kind of see it as an estimate. That's the average yield over that entire time. So our economy has grown 6.4% over the last 70 years. Corporate earnings have grown 605%. Then 10-year treasuries average 5.6%. It kind of gives you a ballpark of what's going on. Yeah, did y'all think corporate earnings grow 10, 11, 12%? That's what analysts say. Why do analysts think corporations can grow their earnings at 10, 11, 12% when it's just never happened historically? They're obviously very optimistic. GMO has a great article on this. It's pretty hilarious. James Montier, one of my favorite writers, he goes back historically and looks at analyst estimates and compares them to the actual earnings growth later. And it is pathetic. It is so horrible. The correlation, yeah, he should update this too, but the correlation of their expectations and historical earnings is like 90%. The correlation between expected earnings and actual future earnings is negative 0.9. That's pretty bad forecast, isn't it? So it just shows you that analysts, if growth has been good, guess what they forecast? Growth to be good. When growth's been really good, what's usually going to happen? You're going to have a recession. It's going to be bad. They get it exactly wrong. So, but this is pretty important. You have to have an assumption. Why do you think corporate earnings is going to grow? But the nice thing is it's highly correlated to our economy. So it gives us a good benchmark to work with. All right, questions on that? So if someone asks you how fast you think corporate earnings is going to grow, well, how fast is the economy going to grow? It's going to be about that speed. Which brings me up to the next question. How fast does our economy grow? Well, there it is. You know the difference between a good question and a great question. A good question, you know the answer. A great question, you have a chart. So this is a great answer to that question. I have a chart. This is the historical growth in our economy by decade with the three inputs. How does our economy grow? Productivity, labor, and inflation. Which of those is the most important to your wealth? Productivity. There's no number more important than productivity. So productivity, and then you have labor growth. Labor growth is great. The economy grows, but you got more people sharing in it, so you may not win. It'd be great if the economy grows, you have no more workers. That'd be wonderful because then you all get to just keep it. And then inflation, yeah, inflation, economy grows, but then prices go up, so you lose all that to inflation. So productivity is the most important one. Look at productivity in the United States. It's averaged right around 2%. We had 2% in the 50s, almost 3% in the 60s, 2% in the 70s, 1.5% in the 80s. 90s was fairly decent. The 2000s was pretty strong, around 2%, but the 2010s has been really pathetic. Huh?
I was going to say that, like, labor growth technically would be good for you because, like, the economy's not a zero-sum game. So if you have more people in the labor force, that by definition allows for more productivity.
Right. the wealth of your household is gonna be productivity, but you need people working because you're short, like Japan, shortage of labor, that could slow down the economy because you don't have enough workers. So yeah, you want workers, that's good. You certainly wouldn't want workers to grow 10% and productivity to be negative 10% because you're all just gonna be a lot poorer. So what assumption do you make for productivity going forward? Someone says, I expect 4% productivity in the United States going forward. What do you think about that one? I think pretty optimistic. There's a great article, if you want it, I'll find it. But President Obama, in his last year in office, he did I think he wrote an article in Economist. It wasn't an interview. And he was going over what his biggest accomplishments were and then what he was most concerned about. He said his biggest concern was productivity. Why is productivity been so weak? Not just in the United States, it's been some of the global one. Really interesting comments. He wrote it. Who knows if presidents actually write their own stuff? He's got his own writers, so he probably told them interview and someone wrote it for him. It was written really, really well. And his ideas on how to fix it were like more education, more training, those type of things. But the strange thing is, why is productivity so weak? Don't we have the internet? Don't we have robotics and all this? We have all this wonderful stuff. And I know at USA, we introduced a new product at USA. Its growth rate was 70%, and we didn't hire a single person. It was entirely on the internet. We had a few programmers putting on the internet. That sounds like really high productivity, doesn't it? This massive growth in our product, and we didn't hire any people. Where is that number coming from? There's a lot of debates. If you listen to Masters in Business, that guy who writes that, he thinks this number is wrong. That it's miscalculated. But how do you prove that? So y'all know what productivity is? How do you calculate productivity? Yeah, so the Federal Reserve does what? They get real GDP, which is productivity plus labor growth. They take real GDP and they subtract the change in worker hours. So if GDP is up 4%, but we added 3% more working hours, productivity is only 1%. It's a really simple number. You can go back and look at those numbers. So why has it been so weak? UK is going through the same thing. Why is it so weak? China productivity is pretty high, but they're starting to see it decline. When you move people from the country into the cities, your productivity goes up. But at some point, it's kind of diminishing returns. You just can't get that strength. So this is an important number for you. How to get more productivity? Where's it going to come from? So is AI going to make us more productive?
Yeah.
Should be, hopefully so. What about electronic vehicles? Does that sound like a productivity? What about autonomous vehicles?
Yes.
So instead of driving to work, you get in your car to be at work. Your first meeting in the morning is while your car is driving you to work. That sounds like productivity, doesn't it? In fact, a lot of people say productivity increased during COVID. And as they studied it, they discovered productivity didn't go up. What happened was all that time people were spending in their cars going to work, they essentially gave that for free to their firms and did that at home. So the firms got that hour drive to work, they got it for free. So it wasn't more productivity, it was actually more hours worked. It was just, instead of in a car, they're working from home. So it sounds like better productivity, right? It's better use of their time. So if you're going to expect really high productivity, you're going to have to get it from AI or robotics or autonomous vehicles or something, energy, some new energy invention comes in.
Do you think productivity will go up or down? Initiative will turn up.
There's been so many debates. The initial was productivity went up. Since then, they think work from home. People are more productive from home. So initial was people are more productive from home. Since then, they're saying they're less productive. But it's a really hard thing to measure because a lot of people working from home or professional, how do you measure the productivity of an accountant or a finance person? It's really a hard number to produce. So there's a lot of debate. The Economist has had several articles. Their latest articles have been productivity lower. It's worse. From you as young people, it's worse for you because you need to network, you need to interact. That was the key to my success in my job. Is I discovered real quickly in my job that the actuaries were important people. Any excuse I had to go talk to actuary, I did. And no one ever talked to them anyway, because no one knew what they were doing. They were so far above the rest, they just knew stuff we didn't know. So they loved talking to me because I was going over it. So yeah, if we were working from home, I would have I would have, you know, if I called an actuary from home, they was like, who are you? They would have been freaked out. But me walking by their desk and say, hey, this number doesn't make sense to me, that's huge to your career. So you really want to be getting into the office as much as you can. Yeah.
Yeah, so I was gonna say like, first during 2020, like, when we went like to lockdown and stuff, and like everybody was losing their jobs, but people who still had their jobs were like scared.
Oh, working
They're
hard.
like, oh, gotta be as productive as possible
Yeah.
on the computer all day. But then as things sort of settled down, we're like, oh, I can just have a thing that moves my mouse for me and like,
Yeah. And it's so hard to measure. I don't know if anyone really knows. We're definitely working home. COVID switched everything really quickly. So the ideal work from home, now people are saying, well, the people I worked with from Victory Capital, most of them are 2 days, 3 days a week work from home. There is one guy at Victory Capital who gets to work from home all 5 days. I don't know how he got them to do that. So it just depends. USA still has people working from home certain days. So you're probably going to see some of that. I wouldn't, if I were you, I wouldn't encourage it. You've got to be in the office. And if you're not in the office, how do you set up those networks other ways? So when you're in the office, say, hey, you know what? Can I do a Zoom with you Mondays at 3 o'clock? I just really, find those people. I didn't find too many people. I don't think I found anybody. USA had a department. It was 4 PhDs in math. I think I was sitting over there like 5, 6 times a week. And they didn't know they were training me for free. They didn't seem to mind. I'm just soaking everything they said in. So you need that. Is that going to make you more productive? Absolutely. That's your learning curve. I want one thing Robert Arnott talks about as far as where he's going to invest in the world. He says there's productive countries and there's countries whose productivity is improving. Growth is not the level of productivity, it's the change in productivity. And so what he said is a 60-year-old, a 50-year-old versus a 20-year-old, who's more productive? Well, the 50-year-old, why? Because they know a million times more. A problem comes to them, they can solve it, and then it's because they know it. But whose productivity is changing faster? 20-year-old. So Robert Arnott says, if you want a country that's growing fast, you find a young country, young worker base, but with decent infrastructure, decent education. But a country like Japan is going to have a tough time growing because their most productive workers are getting old and retiring, and they don't have enough young workers. So that's kind of his thing. And so yeah, you as young people come in and you're not going to be very productive, but 3 months later you're going to be a lot more productive than when you started. It's a pretty amazing thing. So the age demographics can have a big impact on this number. So all these baby boomers retiring is going to harm productivity. I mean, think about this person was a high go-getting finance person, and now they're playing golf 5 times a week. Which is better for our economy, do you think? How much value? I mean, obviously they're buying golf clubs, so the golf course is doing well, but it's not all that. That's not the best use of that person's time. Would you agree? So these are numbers that are demographics. And on labor growth, we had really strong labor growth in the 50s, 60s, and 70s. Where did that come from? Well, you got soldiers coming out, but what else did you have? Who joined the workforce? Who joined the workforce 50s, 60s, and 70s? Yeah. Women, yeah, you had a large inflow of women join the workforce. That's kind of what Japan's trying to do. You listen to Abe, who unfortunately was assassinated, but Abe, it's like, how can I get more women to come into the workforce? And they were trying things like, daycare, those kind of things, getting women to come into the workforce is really tough to get that. That could be the salvation for Japan, get more women, get the participation rate in women. But you can't do that again, right? Once you get women in, we could go back and reintroduce child labor. That could work, right? That'd give you a whole new workforce. Want to do it. And the amazing thing is, during the 2008 decade, we actually, for the first time in U.S. history, we actually had fewer workers at the end of the decade than when we started. That is pretty amazing, isn't it? Pretty crazy. Now we come back pretty strong. We've had pretty strong growth in employees, but they haven't been all that productive. So wherever they are, I do have a theory on this. It has to do with, so there are certain industries that are extremely productive, and they keep shrinking as a percentage of our economy. And there's 2 industries that are horribly unproductive that are growing really fast. Y'all know what those 2 industries are? You're sitting in one of them. Education, horribly unproductive, and is growing really fast. We're spending a lot of money in the public education. What's the other one that your grandparents like to use a lot? Healthcare is a terribly unproductive industry. And those healthcare is growing fast, isn't it? Terribly unproductive because a lot of it's, I mean, I think this sounds morbid, but a lot of it's spending a lot of money to keep a 90-year-old person alive for another 6 months. What does that do to our economy? Not all that valuable. It may be value for the family. You're glad they're alive. They can come to your graduation, whatever. I'm not saying we want the person to die, but it's an incredible amount of expenditure, which is going to really harm productivity because it's expenditure on people who are already retired.
Oh, yeah, no, one of the reasons why, like, healthcare wise unproductive and education as well as all the money that the government charges for going to experts and for US.
Yeah, my life insurance class is going to talk about there's incredible waste in healthcare. AI has been pretty promising in healthcare. AI reads x-rays better than technicians do. AI is much better at understanding how things work, but the incentives in healthcare are horrible. If you go to a surgeon, guess what he or she's going to recommend? Surgery. Yeah, you go to a barber, what are they going to recommend? A haircut. If you go to a surgeon, they recommend surgery. Are you going to debate with them? Probably not. You're going to trust them. That's the biggest. The incentives are terrible. What about education? Can we get education more productive? What's the biggest productivity gain in education? Are y'all learning faster with fewer professors? Or not? Not doing very well. Are there some good models out there? Yeah, there's a millionaire in South Korea selling classes online, and he's got millions of subscribers. Yeah, I mean, it's very, very unproductive. Why? Because you have a teacher teaching. In fact, they've discovered U.S. was really big about let's shrink class size. And then the people who study say it's not class size. One good teacher with 500 students is far better than a mediocre teacher with 50 students. It's the quality of the teacher, it's not the classroom size. But teachers don't like that because you want more jobs for teachers.
Yeah, teaching is it's all game. The best teacher is teaching.
Well, that's the South Korea thing. Is this one guy has proved that he can teach, and you think about the Khan Academy, he teaches as well as any college professor I've seen. You could learn it all from him. You know, I was going to write a blog this summer, but I never got around to it. But what college should look like in 10 years from now, I have a pretty strong idea about it. But we'll see. There's a lot of incentives not to do those kind of things because you got the status quo that are going to fight hard. So you notice how these two things go together. So why don't we have much productivity? Well, it's because our least productive industries are the fastest growing. Our most productive industries, they're so productive, they don't add any work. You know, they're there. I saw a number on steel production, and it was amazing how much steel we produce today versus how many people you need to do it versus in the 70s. It's off the charts. We produce so much more today. So there's a lot of industries that are incredibly productive, have done a great job, but you're not seeing that because I think healthcare and education were just pouring more and more people into that without much extra benefit. And then inflation is inflation. So if you take the medians historically, 2% productivity, 2% labor growth, 2% inflation, you get about a 6% growing economy. When's the last time we grew 6%? In the 90s, right? So why aren't we seeing productivity from the internet? So that's a good question. So I don't know. I can't answer that question. I feel a lot more productive. I can do stuff a lot faster, be able to dump stuff from the internet, but somehow it doesn't get into the numbers. There are problems with GDP. It's an estimate. We don't really know what our economy produces. It's an estimate. And you'll notice countries, I think it was Kenya, or boy, not Kenya, but there's an African country. Oh, what are the countries around Kenya? Kenya, Ethiopia. It might have been Ethiopia. What's the other one? Right next to Ethiopia. I'm trying to picture Africa on my right. So I mean, it's one of those three big countries right there. They decided to start counting one part of their economy they hadn't been counting, and suddenly they became the largest economy like overnight. They massive, just not because something happened in the economy, just because of the way they counted it. So there's a lot of counting issues. The economists these are estimates, so we don't really know. There could be a major problem with this number. So what in the US is a major part of our economy that we're not counting? We don't really have an underground economy here like they do in Mexico and other countries. People are kind of avoiding taxes by being, outside of the formal economy. I don't think we'll have, maybe the drugs, we're buying so many drugs in the US, so that's, 5% of our economy. Probably not. There's probably not some missing part of our economy. But in other countries where they don't have as good of a measurement system, it's possible there's a massive part of their economy that's not even being counted. But we're stuck with the data that we have, and this is the data we have. This is another one of these things is having a perspective on these numbers, so you know what to look for. You can look up productivity. I think I put a productivity chart in here somewhere. I don't know, and I guess not. I thought I had. So you can look. You can certainly look at productivity historically. Why do I type Fred every time? Get the Federal Reserve. Oh, we can go back further than that. So there it is historically. I don't like the annual numbers. I like to do like a 5-year smoother, so you can get all that in there. You can certainly see the recessions, right? How productivity falls in recession. That's not always obvious though, because a lot of firms do. Well, it is kind of. So what happens in recessions? A lot of firms won't lay off enough workers because they're worried they won't be able to get them back, but the workers won't have enough to do. So they keep more workers they really want. So productivity does tend to decline right in the middle of recession. So you will notice that it's more coincidental than leading economic indicator, but an important number. You can see 2020. That number is really kind of artificial. That 2021, you had the sell-off, and then you had to come back, but it's somewhat of an artificial number. But good numbers to have. And what if you want these numbers? You can get them right there. Again, how long would that have taken me at UT Austin in the 80s? Some book, I would have to write all the numbers down, and then I don't know what I would have done with them then. I guess I could have done averages. And then I could have graphed it. Where would I graphed it? I would have got on some cardboard board, and I would have done it by hand. It would have, I mean, you guys would. Where's all that productivity? Because it's certainly there. I just did something in a few seconds that would have taken me ages before. So if you're going to if you're going to be a stock investor, you have to have a good understanding of what drives the U.S. economy: productivity, labor growth, and inflation. You got to understand those pieces. So historically, stocks have had a 4% yield. That's not true today. It's much lower than that today. Today it is so to get the yield on the US stock market, you can just type in SPY, which is the Spider S&P 500, and its current yield is 145. So what would you expect going forward? But that's it, 145. Pretty low number. And about 6% earnings growth. So historically, stocks got you a 10% return, but with a much higher inflation. So inflation is more like 3%, 3.5%. So what can you expect going forward? Well, maybe use 2% dividend yield. Productivity, 2% productivity growth, 1% labor growth, 2% inflation. Maybe our economy grows about 5%. This next economic number may be pretty strong, but it does fluctuate quite a bit. So in my opinion, if you're going to forecast U.S. economy, including inflation, not real, but nominal GDP, I think the 4 to 6% range is what you're stuck with. I don't think you can get much above 6. And I even think if you think productivity is going to be strong because of AI, I think you're going to have to say if AI takes off, labor growth is probably going to be slow because AI is going to replace labor, especially those baby boomers. So I think if you have a really strong productivity, you're probably going to have a weak labor growth. Who knows? We'll see. But somewhere in that 4 to 6%, which means corporate earnings should grow somewhere in that 4 to 6% range. Productivity is Innovation, where the US is still very strong on innovation. We still have the Silicon Valley and we have other places. US is still leading on innovation. China is definitely catching up and is doing some pretty amazing things, but innovation is important. Education system, I don't think the US is so strong on that, but education system. Immigration, you need workers coming in, especially Japan. And then government regulations that can crush, we'll talk about that a little bit more. We'll look at the ease of doing business and just culture. Japan has had a reputation in the past of not letting bad companies go bankrupt. India's had some problem with bankruptcy laws. So you want a country, and that's kind of the advantage of the US, right? You can go bankrupt 3 times and we're like, hey, you're an entrepreneur, go for it. We expect that and you can come back. In some countries, you go bankrupt, you're done for. It's like you loser, you fail. You need a country where bankrupt's okay, you fail, you start again. So that's a big part of it. Just me, Kyle, you had a question?
I mean,
Or am I?
on the topic of innovation in China, in the tech sector, companies are trying to support and keep their innovation in China because they're manufacturing presence and by they have the technology, the economy will grow faster.
Yeah, AI and semiconductors are certain places where I don't know if we're worried, we're making the military argument, but if you can say we don't want them to succeed because they're going to grow faster than we are, we benefit, they grow faster. So, we just want productivity to be up. But yeah, there's a lot of fear of
Well, down all of innovation, sort of tangential manual saying that. So here in the US, Intel is getting their fab in place for the new 3-nanometer silicon chips from ASML. And then tangential to that, like what Daniel was saying is the US government is investing ASML, which is a Swedish company, selling the 3-nanometer machines to China. So they're stuck with the older 5-nanometer technology.
Yeah, so the risk is we try to shut China out, and so they figure it out themselves. You think about in the 70s, we try to keep Japan out. And what happened in the auto industry? Japan said, well, you're going to charge us this major tariff. We'll just make our cars so well that they're still better even after the tariff. So what happened? Japanese cars got a lot better than US cars. That's the risk we try to keep a country out. Now, I actually think President Xi's messing up. So, China's doing horribly this year. I think Xi's messing up because he's telling the people that are innovating, keep it up, but if you get too good, we're going to shut you down. And, you're trying to become a millionaire or billionaire, and the country says, yeah, but if you're too successful, we're not just going to hold you at $1 billion and we're going to take you to 0. You kind of lose incentive to keep doing well.
Yeah, China's like an incredible customer now. In July, they reported for their youth unemployment, so it's 15 to 24, and it was 21.3%. And that was the official Chinese number. And then in August, they're like, yeah, we're trying to report.
Yeah, they stopped reporting.
And then,
China's struggling. You think, this is kind of controlled capitalism, but Xi is, I don't know, I'm not stepping on toes, any Xi fans in here, but he's decided he's in charge. He'll make all the decisions, and the party comes first. And when you make those decisions, you have these tech giants. We're about out of time here. Let's real quickly. So those kind of things you're looking at. We're going to talk about some of these education and ease of doing business because there's some really good charts that we can do. But that's what you're up with when you're looking at stocks. So with stocks, we got 4 areas you're going to look at, subcategories. So it's BUCS. The B is beta. That's where you have cyclical and defensive stocks. The US is US versus non-US, but we have more categories there. We have developed, emerging, and frontier markets. The C is capitalization. We have large cap, small cap, mid cap, micro cap, penny stocks. And then the S style, we have growth and value. So we got to go through each one of those. We're going to understand the definition, what the subcategories are, and then the strategy. The strategies are pretty straightforward on stocks. You expect a recession or growth. That's going to define whether you want small or large cap.